Everyone wants to have cash flow and appreciation when they purchase a real estate deal. But the problem is, most investors don't realize there are two very different paths to get there. There's active investing and there's passive investing. Each comes with its own responsibilities, risks, and rewards as well. Today, John and I, we're going to be breaking down the differences between the two and helping you figure out which one fits your goals best. John, it's great to be here with you.
It's great to be here, Mark. We have a lot of conversations with investors on a daily basis. It's really, kind of where we spend most of our day. And most of our investors have experience on the active side, and maybe this way to passively invest with Faris Capital Partners is relatively new to them. Maybe they've been in one or two before. So I think this is going to be a great episode to really help break down, especially for those that are thinking about investing in real estate. There's watch outs on both sides, right? And so helping you avoid those watch outs is what we hope to accomplish today.
Yeah, right on. And if you are interested in investing and you think passive investing is a good match for you, especially as we get to the end of this, you're like, yeah, you know what, definitely passive is something that I'm interested in. Go to fulloutinvesting.com. There's a sample deal on there, and we actually do a full breakdown of our 10-step full out investing process. Now, even if you are active, you should still go check it out because there's a lot of key lessons that you'll learn on that landing page that we've created for you to actually be that next level active investor when it comes to real estate investing. But yeah, John, when it comes to active versus passive, there's a lot of operators that they were active in the past and they've transitioned to say, hey, listen, I'm at a point in my life where I would rather have cash flow coming into my account without me getting those late night phone calls from, residents saying, hey, my toilet's broken, or, I'm moving out next week. And you're like, oh, crap, I got to get a new tenant in and I'm not going to have income coming in next week. Those roller coaster emotions are something that they've said, you know what, I've had enough of. Or another scenario is, you know what, I just can't find good deals in our area. And, I know down south, there's much more opportunity as just I'm working a full time job or I don't have the contacts that you do. And yeah, I think that we can actually do better investing and partnering with you versus, us going and trying to do the whole, we'll say, other city investing when it comes down to it.
Yeah, Mark. And, interestingly enough, you're not wrong in the sense that, the US probably has more opportunity because of some of the things that, and why we like to invest in the US, generally a lack of rent control and regulations that make it more challenging for that owner. But what's interesting is that because we've seen such a big increase in property values post pandemic, a great example is my father-in-law passed away earlier this year, and my wife is not the executor but helping her sister along with that. And the home he purchased for, a little over 200,000 7, 8 years ago just sold for 490. We had 10 showings over the weekend and 3 offers that came in. Now, this was a holiday weekend in the United States. So it just kind of is even more challenging in the US, even because at the end of the day, the property value and the rents aren't necessarily always correlating, but still opportunities out there to be sure. But, Mark, I mentioned talking to investors, and we talked to an investor not long ago. And the reality of the active investing is it can be very rewarding, and it's not something we're trying to talk you out of doing, to be very clear. But what his challenge was is he had done everything correctly, and over time he had amassed a portfolio of just shy of 20 properties. But then what he was finding is it was now taking him a full weekend plus a day, so 3 full days, just to drive these properties to ensure that they were looking good and in good condition. And so, all of a sudden, what is an investment starts to feel a little bit more like a full time job. And he already had a full time job, right? And so, sacrificing weekends. And so, once again, this is not a conversation where we're steering people away from active, not at all. We're going to talk through the pros and cons of both active and passive investing. But, it does come with challenges. So, it's that idea that if your goal is to just be an owner of real estate and manage those deals, and that's your income, the active approach is really a great approach if you're wanting to supplement your investments and have two or three. But when you hit a certain number, all of a sudden it is becoming a full-time job, right? So it's really about, the investor needs to really look internally and figure out what their goals are over the next 1 year, 5 year, 10 year, and then build a strategy based on that. So it needs to be very a thoughtful plan, I guess, is my point there, on which direction you go, or maybe you do a little bit of both, right? Which I think is actually the best strategy potentially. So definitely looking forward to diving in here. I think it'd just be quick to just kind of do a quick little like summary of active versus passive, just so everybody's very clear. So with passive investing, you're investing your money into a deal or a fund that is operated by somebody else. So, your responsibilities are really to provide the capital and then to protect yourself by doing a lot of due diligence and research into the deal and the operator itself. You really don't have much decision making authority. And in most cases, you have no decision making authority, nor management, nor authority on execution. Now, I will say there is a form of passive investing where if you're investing a significant chunk or the bulk of the capital, you can probably negotiate in some management decision making authority, typically on major decisions like exit, refinancing, et cetera. So your typical vehicles for passive investing are going to be real estate investment trusts. REIT is the acronym that you'll often hear in the industry. Could be private equity funds or in real estate syndications, which is what we at Faris Capital Partners do. Active is you're sourcing the deal, you're raising the capital if necessary, whether just through your own savings or through partners, managing the property managers, the contractors, handling all of those details. And most importantly, you're in control. So you have all the decision making authority. You're responsible for all outcomes, good or bad. And those typical vehicles for those styles of investing is like direct ownership, could be a JV partnership. We talk to some investors, often they're like 20s and 30s, where maybe them and a couple of friends are pulling some capital together to do some deals. Or it could just be you buying a property and just managing it as part of your personal portfolio. So that's really what we're talking about when we say active versus passive, right? Just to kind of clarify and define what those two things really mean.
Yeah, John, why don't you keep going here and talk a little bit about the pros and cons of, let's start with passive investing. What are some high level, and I'll maybe fill in the gaps, if
Yeah.
any, from passive investing. What would be, say, some pros and cons if we were to dive in a little further than what we've already been talking about?
So absolutely. So some pros of passive, it's hands off, right? So if you do your due diligence on the operator in the deal, nothing's guaranteed in life. There's all kinds of economic events that occur and things like that. But at the end of the day, you're giving your money to somebody else and putting your trust in them to do the execution. So this style of investing, in my mind, is really something that's ideal for a busy professional or even potentially a retiree, right? Because our deals and many passive investment deals, and you have to look for this, right? But have cash flow that's coming in on a monthly or quarterly basis. So a lot of retirees like that. They're building wealth, making sure their retirement will be well looked after with good income coming in, as well as, increasing their savings through the return on exit. But once again, those busy professionals, it's the idea that if you're working 50, 60 hours a week and you're an entrepreneur, and most entrepreneurs I know are never truly off, right? Weekends, they're maybe hanging out by the pool or playing golf, but they're thinking about their business and they're thinking about, things they need to do to improve operations and all these things. So, a lot can view having an active deal that they're managing as a bit of a distraction, right? So that's typically who is investing in these deals. What you're doing when you're investing as a passive investor is you're really leveraging experienced operators, right? So you're using those experienced operators as a lever to increase your wealth. So, where somebody could kind of say, oh, I know this area really well, I've lived here my whole life, I think this might be a great deal, they may miss something, right? So having a team of experts behind the scenes making these decisions is something that can really, protect your downside, right? For me, this is all about diversification when we're talking about investing in real estate. At the end of the day, I think any prudent investor should have some stocks, some bonds, and some real estate in their portfolio or other hard assets, maybe investing in businesses. And so this is a great way for a savvy investor, that busy professional, to diversify without taking on that extra work, right? And then, of course, there's the tax benefits that you get investing in real estate. Now, on the US side of the border, it's a little bit more advantageous from a tax perspective, but there is still certainly some advantages that Canadians get as well with depreciation and things like that. Now, the cons are you are not in control, right? And what we've seen over the past number of years is a lot of operators, kind of got drunk on the market, right? The market was going really well and they started loosening their buy box and buying at the peak of the market. And so there are some deals that have been challenged. So, for that investor, it's important not to just be blindly trusting in this deal, in any deal, right? It's really doing your own research, but that is a downside, right? You have no control. So, maybe you see an investor update and you don't particularly agree with the strategy, there's really not much you can do about it. Now, Faris Capital Partners, we're touching base with our investors often and we're asking for feedback. And when appropriate, we try to incorporate that feedback. But at the end of the day, we have to make the decision that we think is best for all of our investors. So you are losing control as a passive investor. And typically your liquidity, is a bit lower because, at least in our world, we do 5-year holds with an optional 2-year extension. Now, we never plan to utilize that 2-year extension, but if we have to, in order to look after our investors, we could. So your capital is locked up during that period of time. So this should not be capital that you may need access to in the next year or two, right? This is truly a longer term investment.
Yeah, yeah, and so the control is one. That's a if you've always looked after your own investments and it's like, listen, I don't want to give up making decision rates at that point. I mean that for some investors, that's just they want to continue going on with that, and I think that is one. And then also depending on which, we'll say, passive investing strategy that you go after, like say with REITs and some of these other investments, there's like certain caps, like you don't participate with the upside. And where I saw that, where there were some REITs that the market was going up by 20, 30%. And I'm like, why on earth aren't these REITs going up? Because you're basically buying shares in, say, stock, for example, but you don't participate with the upside. Where if you get into the right passive investing vehicle, you can participate. So that would be the other downside to say passive. If you go into an investment, you don't have that same upside potential. And that, I think, is the big, we'll say, perhaps the holdback for a lot of investors is the mindset is I'm actually going to do better if I buy it on my own. And in a lot of cases that's accurate, but if you get in the right investment vehicle, you can actually participate in leverage not only a team that is experts at what they do and do that full time, but if they have a certain waterfall structure, you can get into a deal where if the market goes up by 20%, you're going to participate with all that upside and have no sort of cap there. So the control, I think, is probably the biggest one, John, when we're looking at all the pros and cons, or we'll say the cons of going passively. The other is, in some cases, you may not get as high returns than if you do it on your own, especially if you go into, say, like a certain REIT structure.
Yeah, that's absolutely right. So, on the active side, right, some of the pros there are, basically what you just said. You have full control. So, if you're somebody who likes control, Mark, you and I, we study behavioral profiles, right? It's really, I think, part of our secret to success when we're hiring. We really look at the behavioral profiles of each of our employees. But when we're talking to investors, we're thinking about that. And some of our investors, right, they're wired and they have that need for more information, right? And so, these 16 core behavioral styles. And so, there are certain personality and behavioral types that just need to be in control. And so, if that's you, that's great. Maybe active investing is that right approach for you, having control over all aspects of the deal. To your point, Mark, there is also sometimes the potential for a higher potential return if executed well on some of these active deals, right? And maybe it's a house flip, right, versus a rental, and so you can come in 3 to 4 months, complete your renovations and turn the deal for a profit. So that goes back to, and I'm going to jump ahead here. One of the cons is that you need to understand that if you're doing a flip or if you're buying a rental property, you're effectively buying a small business. And that
Mm.
rental property is a small business, right? That flip, while the period you own it is a small business, it is not a hobby, in other words. And so it could become a full-time job very quickly. Now, going back to pros, I think one thing to mention is, you're building direct equity. You're also building internal systems, right? So if your goal is to own a portfolio of 20 rental properties, you got to get started somewhere, right? And so that goes back to, if your long-term goal is to maybe leave your full-time job and just become a full-time real estate investor, then maybe that active approach is more for you. And you're building out those systems as you go. You're learning, you're improving, and you're able to execute there. Now, the cons, going back there, and this is one of the reasons you and I, we love apartment buildings. But one of the cons of owning, say, a rental property is if you have one rental unit and then you have one bad resident, in other words, somebody who's not paying the rent on time or is causing damage to the property, you're jammed up, particularly if you live in a market that makes it difficult to remove a non-paying tenant. So we often talk about Canada and the US. Well, in the US, the majority of states tend to be more landlord friendly, but we have quite a few that are also more tenant friendly. And, for example, in New York, New Jersey, California, some of these markets, very similar to Ontario, it could be 12 to 18 months to get a non paying resident out. And so, I have friends that are big into the active investing. And it's like, what they tell me is they really had to have 7 to 8 deals before they felt like they could
Mm.
sleep at night, because one non-paying resident, like, they could absorb that with the other 7 or 8, right? But it's just one of those things, man. Just having that one, and then you're responsible for that full process, right? So you may be working with a property management team, but what if you select the wrong resident and then it goes sideways? Now you have doubt and frustration internally. So you're just taking on some additional stress there. And at the end of the day, as you build your portfolio, you have to build a team, you have to manage people, raise capital, and sort of oversee everything. So once again, it's really about what your goals are and where you want to be. And I think in anything in life, it's always good to have a 3-year vision, right? So that 1 year, 3 year, 5 year. And if your goal is to go that direction and become an investor, then you need to get into the active side of things. But if you're a busy entrepreneur or professional and you're looking for ways to diversify into real estate, maybe the passive approach is better for you.
Well, the big one that actually really resonates with a lot of our investors, John, is the hourly rate factor. And so
Yeah.
what's really interesting, it's like, okay, well, I can get 20% if I do it on my own in annual returns. Then, the question is, okay, but how much time are you going to be putting into this? And so if you say factor in, okay, I got to put 100 hours in, which is a very little amount of time if you take a deal from start to finish and you do say you do a flip over a period of a year, like 100 hours is easy to get eaten up. And so if you're worth, let's just say, $100 an hour and it takes you 100 hours, well, that's $10,000 in expense that's going to cost you, and you have to factor in that $10,000 into your overall returns. And a lot of active investors don't factor in their own time and what they're worth. And so, John, this is something that you and I we're massive on, is everything we do, there needs to be a return on investment on that time. And so, don't get me wrong, you can actually, a good investment can be relaxing because you're recharging the battery. But the reality is, if you're spending an hour or 100 hours or 1,000 hours in a real estate deal, the returns need to be there for you if you're spending the time there. And that's something that is hitting costs. Just like inflation, you see that the value of the dollar is going down. It's hidden, you don't see it. It's the same thing on the active side. And so what we tell our investors, because majority of them, they're very successful entrepreneurs and their time is very, very valuable. And so we say, hey, listen, you focus on doubling down on what you're truly good at, and we'll look after everything from start to finish. We'll do all the due diligence and present that so that you feel very comfortable with that. But actually, by us working together, you can get higher overall returns, net returns, with us coming in the deals, these value add deals where we buy them at 20-30% discounts, and then we force appreciation through these renovations. You can get higher overall returns when you factor in what you're not spending on that property and how much money you're going to be putting in your pocket net at the end of the day.
That is such a valuable insight. And I think a lot of people miss that in general, right? But, as a business owner, it's that idea. This is actually, it was funny. This was like the first thing I heard when I got into residential real estate. I started with a team. It was like I hadn't even done a deal yet. And the guy I was working with gave me, this was back in the day where, like, there wasn't podcasts. It was like a CD and it was an interview with a top performing agent. And he sort of said, in the beginning, I was doing everything, right? And then I'm sitting here putting together a flyer for 5 hours. It goes back to, once again, this was sort of pre Photoshop and all the great tools we have like Canva. But he's sitting there going, I'm spending 5 hours making a flyer that I could probably pay somebody
Yeah.
$20 to do. Right.
Yeah.
And so he was like, when I realized that, and that's leverage, right? Because you're, buying back your time. And what he said, what really stuck with me is I'm paying top dollar for mediocre work when I do it myself. Right. And so, it's that same thought process there. So, before you decide if active or passive is right for you, I'd really encourage you to sit down and ask yourself, like, how much time can you realistically commit in a given week to owning real estate, right? If it's 2 hours, 5 hours, like, maybe passive is better for you. Do you enjoy leading a team and making decisions under pressure, right? When that phone call comes in at 2 in the morning that the water heater's out, you got to action quickly. And that can be very stressful, right? And so, that decision making under pressure, leading a team, are you more focused on cash flow or equity growth, or both, right? And what's most important to you? Would you rather scale through capital or operations? And how comfortable are you with risk and responsibility? So going through some exercises where you really sit down and discover what's important to you, what are you trying to accomplish, that'll really lead you to the best decision for you personally, whether it's active or passive.
Yeah, right on, John. Anything else you want to add before we wrap this up? There's not a wrong answer here.
That's
It's
right.
what is best for you. But those questions that you just went through is really important. What you are worth per hour is a really important metric for you to be able to make an educated decision. What's best for you, and you know what? I think it's actually a good thing you try both. It's like, I would never do passive. It's like, why don't you try it, you go into one, you dip your toe in and actually do a comparison so you can get real life experience. Is this something that I like to do more of or not? And I think that's where, if you're going to go in for that first time, I think, it never hurts so that you can see firsthand. And it goes without saying that whoever you do partner up with, that is the operators and their ability there to execute on the deals of untold importance. So making sure that you're doing your due diligence there, but dipping your toe in and actually investing and seeing how that first experience is, I think is something that at the end of the day is just a really good way, because that can change your life completely if you're spending all your time managing your investments versus having somebody else do it and you getting overall really strong returns.
That's right. Yeah. So to learn more about Ferris Capital Partners' approach to passive investing, go to fulloutinvesting.com. As we mentioned at the top, we have a great video on there that gives you a lot of information, not only on how we do it, but just apartment syndication investing in general, a sample deal, a lot of great resources on there. So it'll help you make the best decision for you and your family.
Right on, guys. Well, thanks for listening. If you enjoyed the show, please share and subscribe to the channel. And if you know of any other investors that are looking for passive real estate investments, check out fulloutinvesting.com. As John had mentioned, we love and believe in you guys. Keep dreaming and investing big.